Hello, it's Big Chad, and this is the Trading Encyclopedia Daily Education series on my YouTube, Chad's Trading. You can find me on Twitter at Big Chads and Bitcoin Live, where I am a founding analyst. For today's lesson, we're going to talk about a classical charting concept called time interval. Time interval, basically, it's along the lines of a prior video where I talked about price distance. But time interval basically tells you if enough time, enough price action has elapsed in between levels for it to be considered for price structure. So let's take, for example, a double bottom. You have a move down or an attempted double bottom. You have a move down into a trough or a low, a move back up to a peak, and then you have a move back down to another low, and then you try to move back up. Now, in this construction, it's actually rather clean. You have two lows, and you have your peak above, well-defined peak. You have time interval in between these two lows. That basically means in between when the price set the initial low, August 2024, this is an imaginary chart, and then again, several weeks later, 20 bars or 20 daily, in this case, 3-day candles. So 60 days apart, you have a time interval in these attempts, as opposed to something like this. You have a move down, sets a low, comes back up. So this is not a triple bottom. You might think, well, look, it's a potential triple bottom. There's 1, 2, and there's 3 attempts. At a low, and look, it's breaking out. Chad's triple bottom. It's really a double bottom because this is one attempt. You don't have a significant enough time interval in between, time interval in between these lows. It's essentially the same move. You also don't have price distance. You also don't have price distance from the peak to the trough to the peak. It's really just one move there. So when you're looking at price consolidation, when you're looking at any particular level, and you're trying to decide how many times a level has been tested, how important it is, you want to think about, especially for construction like a double bottom, a triple bottom, anything like that. You want to think about the lows, or in this case the peaks. Boom, 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 boom. Potential double top. Again, you have the price distance between the peak and the trough. Price distance between the peak and the trough, but importantly, the concept of time interval. There's a decent enough amount of time in between these two attempts for it to be considered separate attempts, separate momentum attempts for the price to break out, as opposed to something like this. This is more of an attempted double top, right? Hasn't broken down yet. Attempted double top, because here you really don't have enough of a time interval in between these two attempts. A little bit of a price distance, but you don't have enough time interval. So it's really part of the same momentum story, the same buyers and sellers, the same consolidation structure. So the time interval in between the attempts is an important concept in classical charting, specifically with like a double bottom or double top, triple bottom, triple top type of structure. This is for the Trading Encyclopedia Daily Education series on my YouTube at Chad's Trading. Find me on Twitter at Big Chads and Bitcoin Live, where I'm a founding analyst. Thank you, folks, and I'll talk to you soon. Big Chads out.